What's up, guys? I hope you're doing well. James here from jamesdforsyth.com. So, basically continuing on with going through A Premiere on Money by John William Wright Patman. In this part, he's really taking gold from a monetary perspective out to the woodshed and trying to really murder it, and basically talking about why the government should basically have complete control over the money supply. This is his argument, right? So he actually quotes. He attributes it to Reginald McKenna, Chancellor of the Exquisite. I don't know. In Britain during World War I, right? He says, they who control the credit of the nation direct the policy of governments and hold in their hands the destiny of the people. And so it seems very similar to the whole, what is it? There's a quote by Henry Kissinger, and I'm going to try to quote it off the top of my head, but it's like, if someone controls energy, they control people. If they control the money, they control the world, or something along those lines. It's obviously not verbatim, but similar, right? Those who control the gold control everything, or control money, whatever you want to define money as. That's a separate topic. Okay, so, and then he goes into like what's kind of backing the US dollar, because obviously he's doing it from a US dollar perspective. So, but from a much more basic point of view, the dollar is backed by the credit of the U.S. government, and accordingly by the credit of and assets of all of its citizens. So this is what I really wanted to kind of drive home, because everyone looks at, like, a lot of people know, or it seems well known, that the U.S. dollar is backed by the full faith and credit of the United States. Okay, but what does that even mean, right? And so, yeah, it's the credit of the United States, but like, if we default, what's that mean? And so basically it seems from his argument that means that credit is backed by the assets of all American citizens, right? And so it's like, okay, maybe I'm reading too much into this, but if that's true, that's kind of a big deal. Basically, if it makes it seem, and I'm not 100% sure on where all the nuances would lie, but essentially, like, all private property rights for American citizens would then be, according to this interpretation, let me put that disclaimer in there, is basically founded on the U.S. government's credit, right? And so, like, if the American government defaults or has a loss of faith, their credit is basically crap, according to, or whatever it's deemed by foreign countries, then essentially that could be American citizens' assets could be seized by whatever. Like, I'm not really sure what the nuances would be on that. I'll definitely have to look into that more. But that's one of those, I don't know if it's just he worded it a different way or whatever, but I thought I would definitely bring that one up. I put 2 stars next to it to remind myself, right? And so then now we get into taking gold out by the woodshed, and he really tries to hammer the point home that gold is essentially worthless as a form of money. So he says, yet almost anyone who found a gold nugget or somehow came into legal possession of gold bullion would sell it. That is to say, he would exchange it for dollars because he could spend or invest the dollars but not the gold. This raises the question whether it was the dollar which needs or needed to be exchanged into gold, or the opposite, right? And so basically, what are you putting the value in? Is it the dollar or the gold? And so, I mean, my argument would be, okay, yes, but that's because the U.S. dollar has been made legal tender, and so those people have to sell their gold if they want to do some form of transaction in U.S. dollars that you necessarily have to have legal tender for. So, and that would be like taxes, right? For an example. So you're kind of forced to. But that's not necessarily, just because the government mandates it doesn't necessarily mean that gold has no value. So, I don't know. Okay, so, and then he gives a stereotypical argument. There was never enough gold in the country at any time to supply gold in exchange for all the dollars, but that's assuming that the price of gold is fixed in dollars, which kind of intrinsically puts the value on the US dollar. If you put it on gold, then the dollar price of gold can just fluctuate depending on the value of the dollar, because it's all relative, right? It's the price of gold relative to what? Is it in gold itself? Then an ounce of gold is an ounce of gold, and that's it. If it's relative to the US dollar, then okay, it's this many dollars for an ounce of gold, and it can fluctuate depending on whatever, right? And so basically, to continue, is like, why has it gone off the gold standard? In terms, like, why has the United States actually gone off the gold standard? He says the gold standard usually means that people may exchange their paper money for gold whenever they desire. Today, the dollar can be exchanged for gold only in international transactions, although we still define the dollar in terms of gold, right? So in other words, we owe foreigners money. When we owe foreigners money, they may collect it in either gold or in goods and services, right? And this goes back onto the difference between a gold standard and a gold exchange standard that I went into a little bit in the previous video. Essentially, to where a gold standard is where everyone can redeem their dollars for gold, because that's how you're defining a dollar. And then a gold exchange standard is only when foreign countries, is when international settlement can be settled in gold, right? And so, like, foreign countries can get gold, as he says, but U.S. citizens cannot, right? And so, did going off the gold standard change the basis of our money? His response is, in practice, of course, banks frequently make loans secured not by any specific assets, but only by the general credit standing of the company or individual. If the loan is not repaid, the bank can sue and collect its money by forcing the sale of whatever valuable assets the company or the individual may have. And so, I'm not really sure his little spin on this, because it's one of those, he says it's only by the general credit of the company or individual, but they can also essentially seize the assets of that individual if they fail to repay, which basically kind of, it seems to me, it's just whatever asset they would seize would be the collateral for the loan. So is it really based off of the credit of the individual alone, as he says, only by the general credit of the individual, rather than also, or at least some function of the credit of the individual and their collateral? Especially, like, what comes to mind is the difference between for lending for like commercial and residential real estate, to where, you know, when you get into more of a commercial space, it's based more off of the property itself, rather than if you're buying like a single family home and it's based off of you. But anyways, so next question, if we do not have a gold dollar, what kind of dollar do we have? So he says we have what is sometimes called a managed paper currency. The dollar is based on credit, and every dollar in existence represents a dollar of debt owed by an individual, a business, or a governmental unit. So money is debt, right? Debt is money. You hear that from like people like Robert Kiyosaki all the time, right? And then also, is money wealth? He says no. Money itself is not real wealth. It is only a claim on real wealth. What does that mean? That means that you're claiming wealth, right? So therefore, what is wealth? Well, what do you use US dollars for? You use them to buy goods and services, or like buy a house, buy stocks, whatever. So it's the actual things that are of tangible value that are real wealth, right? And so it's the business itself, it's the house, it's the food in your fridge. That's what's mattering here. It's not the amount of dollars it takes. It's not the dollar itself. It's the amount of dollars that you would need to spend to get it, right? So the actual real wealth is the stuff, not the money you need to get the stuff. Yes, you need money to buy the stuff, but that's not the real wealth, right? You can't eat $1 million in your bank account. You can eat $1 million worth of food, but not the money itself, right? Okay. And this is the whole reason we have to transfer this, as he states, is we use money because money makes it easier for a nation to produce and distribute goods and services, basically with a country based off of essentially just trade and industry, commerce. I mean, a functioning society, it makes it much easier, and that's why and it flows easier. And I think that's a very accurate term, because I mean, we think of money and lots of money in terms of liquidity. You hear that term thrown around all the time in kind of financial lingo. So the more liquid a market is, the easier it is to pull money in and out, because it's easily transactable, right? It can flow very easily. And then when you have something called a liquidity freeze, it literally seizes up and stops flowing, right? So I think that's a very good way to describe it, right? Okay, so, and then he goes, why must money be managed? He says, they would indeed be foolish. Oh, talking about gold, right? And so basically we have to only use, or the government should be in charge of US dollars, and that should be like money itself, right? And we shouldn't be on a gold standard, because as he states, they would indeed be foolish to select a monetary system which leaves the amount of money to chance or an accidental discovery of gold, right? As if basically the whole thing is based off, the whole monetary system is just us happening to find more gold in the ground, right? Rather than, we already have a base of gold. But then again, from the other things he stated, I think the reason he says it like this, and basically why it would be foolish for a monetary system to be based off of an accidental discovery of a precious metal, would be that the price of that precious metal, in this case gold, is only measured in dollars, and is then at a fixed value of dollars. And so that's all that matters, according to him. And so basically, that's all you have. And so in order to increase the money supply, you would have to increase the amount of gold at that specific rate. Basically, otherwise we'd have a very inelastic money supply. We're not even going to worry that, they can change the value of gold in terms of, they can change the value of gold relative to US dollars, would be the best way to say it, right? And you can see this in we talked a little bit about it in the previous video, when FDR basically confiscated gold from American citizens, and then it was priced at, I think it was $20.67 an ounce, I believe. Somewhere in that range, might not be the exact number. And then basically, as soon as he confiscated it all, he immediately devalued it and put it at $35 an ounce. And so, take that for what you will. Basically, taking the gold from American citizens and then immediately decreasing their purchasing power by almost half, roughly, obviously. Quick math, but yeah. And then basically starts to talk about money supply, and that's pretty much it. And this is more of M0, where it's based off of demand deposit, so commercial bank liabilities, the money in your bank account, and then any currency or coin that's in circulation, right? And that's it for this chapter. More on currency and coin, though. I'm reading a book right now called Fed Up by Danielle DiMartino Booth, I think is her name. And she worked at the Dallas Fed for a while, and I didn't know a lot of the stuff she was talking about for currencies, and I'll definitely bring it in so I can give you the exact numbers and stuff that she was using. But it's there's a specific rate at which they actually start destroying physical currency, in terms of, and she had this something around $20 million a business day in physical currency is destroyed, because it's just too old, or I mean, because it's physical, it changes hands, and so the paper is going to break down, and it's like 75% cotton and then 25% something else. Like I said, I know I'm just reading the book now, and so it's one of those I'll have it actually in front of me. Now that I think about it, I just kind of wanted to share, because there's some cool facts when it comes to the actual currency itself. I think they're cool, at least. So we'll see. I don't know. The next few videos, I guess kind of as a little bit of a teaser, are going to be more on how money is created and stuff along those lines. So more of the history of like how goldsmiths were involved, how fractional reserve banking came to be, and stuff like that. So yeah. Anyways, I'm going to leave it at that. Hopefully sometime soon I will be home for more than a night, and so you won't have to deal with the background of a truck, and it'll be actually in my house. I've been out of town for work for a month, honestly, because when you're out of town, you work every single day, including weekends, and so like I don't even remember what day it is, to be completely honest. I know it's June 27th as of this recording, so I think that's Monday. But anyways, I'm gonna leave it at there, and the sun is coming up, so I have to get ready for work. So anyways, I hope you guys have a good night, I guess day, and I'll see you on the next one.